Hello, this is Jordan, and this video is being recorded on the early evening of Tuesday, September 24th, 2019. And today I'm going to discuss optionality plays. So starting off, let's define what an optionality play is when it comes to mining. And like the name says, an optionality play is essentially something that has an option on higher metals prices. The deposit and company that owns it has little or no value at low metals prices, but then it gains significant value as metals prices increase and continue to increase. Now, Rick Rule's words are at the bottom, and that's from the perspective of a mining company, which is hoarding an enormous, and I put in the phrase low grade deposit when metals prices are low, and then selling the deposit when prices are high. So if a company has something like this, a project or a deposit that meets these definitions, then they have a long-term option essentially on higher metals prices. Now here's some criteria I use when evaluating optionality plays, and the first two are the most important. You want there to be an ideal share structure and some cash. If a company has a bloated share structure with some 200 or 300 million shares out and then lots of options and warrants, that creates too much supply of stock. That's potential sellers in the future because that's a greater supply of stock. Not having enough cash, then that results in essentially having to raise money every 6 to 9 or 12 months or so, and that means more financings and then inevitably a greater supply of stock. Now, jurisdiction is also very important because no one is going to consider or buy a low-grade deposit that's in a questionable jurisdiction. That's just too many potential fatal flaws. Now, as far as actual optionality, I don't go for absolute bottom of the barrel. I want to see something that could work potentially at, say, 1,500 gold or $20 silver. I avoid deposits that are so low grade that they require 1,700 gold and $25 silver for just 20% after-tax internal rate of return. Now, a lot of these companies have studies out on their projects and these deposits, and so you can find information on these studies on their website, and you can use that to evaluate the potential economics. Now, lastly, a major U.S. listing really helps, and that's because generalist investors who buy gold and silver stocks, they do tend to go for optionality plays, and they'll tend to look for the ones that are in good jurisdictions, which first and foremost, that's North America, then Australia, and sometimes in South America. Now, my final comment on optionality plays is that every mining company or every gold and silver company, it's an optionality play of sorts. I mean, even quality companies with quality deposits, they will gain value as metals prices rise. Although, number one, in optionality really isn't your reason for buying in those cases. And secondly, those quality situations, they're not going to perform as well as something that is an optionality play that's so far out of the money, but then it suddenly becomes in the money because of a move in metals prices. That's all for today, and thank you so much for listening to this video. You can follow all of my work at thedailygold.com. You can opt in there for my free book. You can consider my premium newsletter. It's only $149 for 6 months. That's at thedailygold.com/premium. We focus on market timing and stock selection in the juniors. If you want to know which juniors have the goods and really the best potential to triple or quadruple in the next year or two, sign up for our service. We'll let you know it's highly affordable. Thank you again, and I look forward to publishing another video update for you guys in the days ahead. Thank you.